A bank manager walks into his branch with a paper check. In the figures box, he writes 2.5 crore. In the words section, he writes 25 crore. He signs it using the name of an officer who hasn't worked at that branch in months. And despite these glaring red flags, the transaction clears. This is not a hypothetical scenario from a training manual. It is how nearly 590 crore rupees vanished from IDFC First Bank in one of the most significant internal frauds in recent Indian banking history. This case is a stark reminder that our greatest vulnerabilities often are not external hackers, but the people who hold the keys to the kingdom. The mastermind behind this operation was Ribhav Rishi, a trusted branch manager who exploited the very systems he was supposed to protect. Within a span of 5 months, Rishi orchestrated the unauthorized siphoning of government funds intended for housing schemes. He did not use a sophisticated cyber attack. Instead, he relied on the Achilles heel of modern banking, manual check-debit transactions, and the systematic bypass of maker-checker protocols. Rishi's method was deceptively simple, but relied heavily on internal collusion. He forged the signatures of senior officials, including a former special secretary named D.K. Behera. The D.K. Behera twist is perhaps the most shocking aspect of the investigation. The signatures were being used months after Behera had already relinquished his charge. The funds were then routed through shell companies, most notably Swastik Desh Projects, which received over 300 crore rupees. What makes this a critical case study is the sociology of the heist. Rishi did not just forge documents, he built a culture of manual overrides where subordinates were conditioned not to question discrepancies, even when the amount in words was 10 times higher than the amount in figures. For 5 months, these transactions continued without triggering a single digital alarm because they were processed as manual entries, effectively flying under the radar of automated fraud detection. The fraud only surfaced when a government department requested to close an account, revealing a massive balance mismatch. This raises a difficult question for any compliance team. How did both internal and external auditors miss these large-scale manual debits for 5 consecutive months? Once the alarm was raised, the response was unprecedented. IDFC First Bank managed to repay 583 crore rupees to the government within just 24 hours of detection, primarily by placing liens on the suspect accounts and issuing recall requests. While the bank's quick financial recovery is commendable, the structural failure remains a point of deep concern for the industry. The bank is now moving toward AI-driven signature verification and digital-only high-value confirmations to remove the human element. However, we must ask if technology can truly stop a senior manager with the authority to override the system. This case proves that the new normal in banking is not just about better algorithms, it is about the end of manual protocols that rely solely on human trust. For those entering the compliance field, the lesson is clear. The most dangerous threat is often the one that has already been invited inside.